Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hi, everyone. Welcome to the May 14th edition of Macro Minutes, entitled Data Determination, being recorded at 9 a.m. Eastern Time. I'm your host, Simon Deeley. Markets have been ultra-sensitive to data for some time now, going back to market pricing for hikes starting in late 2021. More recently, several strong U.S. inflation prints have derailed the potential for upcoming Fed cuts, while upside surprises have occurred in Canada, UK, and Australia in recent weeks. Will these data points be determinant for upcoming central bank moves? What important releases are to come? We are fortunate to have RBC experts from across the world to provide insights on the situation in their respective regions. I will kick off by reviewing the Canadian jobs data and setting up CPI next week. Reid will discuss a busy week of U.S. data, including CPI. Cathal will review the situation in Europe, and Su-Lin will go over Australian dynamics. Finally, our new LATAM FX strategist, Estrada, joins to provide an update on currency markets. So kicking off with Canada, heading into last Friday's jobs report, market pricing was 60 to 65% for a cut at the June 5th meeting. The report showed an outsized 90K increase in employment, but the unemployment rate was steady at 6.1% and even edged higher on an unrounded basis. This was due to an even larger increase in the labor force, as immigration has driven strong population growth and new labor market entrants, and the job market has been unable to fully absorb them. Wage growth remains around 5%, just under, in this report, but other releases are tracking 3 to 4%, and the BOC has noted some preliminary signs of moderation on this front. Overall, the jobs report lowers our conviction slightly for a June cut, but we still see it as likely with a 70% probability. The main data release ahead of June meeting is undoubtedly the May 21st CPI report. In complete contrast to the US, Canada has seen 3 straight prints averaging just 0.1% month on month for CPI trim and CPI median, our main core measures, with even the service-oriented super core measure trending lower, currently at 2.8% on a 3-month annualized basis. What does the BOC need to see to cut on June 5th? Monthly prints for the core measures at 0.2% or lower would increase our conviction. Between 0.2 and 0.3% would be roughly neutral to our expectation for a cut, and 0.3% month on month or higher would reduce our conviction level. The other main data release before June meeting is Q1 GDP on May 31st. With our forecast and preliminary Statistics Canada tracking at plus 2.5%, boosted by a return of striking public sector workers in Quebec in January. The risk to our June cut call is that the data lacks the impetus for the BOC to cut, with adjustment cuts in general less urgent for central banks. They may see waiting to July as a reasonable option. Either way, we expect a sequence of cuts once the BOC does start to move. While we don't see it as a main impediment to near-term cuts, a lack of easing from the Fed could cause a more cautious BOC later this year or early next year. For more on the situation south of the border, we turn to our U.S. economist, Reid.
Great, thank you, Simon. And looking ahead here to Q2, I think it's appropriate that we just got our first inflation report for the month of April here in the PPI release. And what we saw there was an elevated print, surprise to the upside, really does little to kind of, reverse some of the trends that we saw in Q1. Encouragingly, we did see goods prices remained rather modest, but worryingly, we saw upside pressure coming in the services space. And really what that means is the pass-through to PC later this month will be rather strong. And this really puts the Fed in a tough spot, given the data that we did see in Q1. We are looking for CPI to step down slightly tomorrow relative to what we were seeing, notably in January and February, but still with a 0.3 month-over-month print, which we are expecting in the core space. That really just resets the clock in terms of what the Fed needs to see for a sustained path lower. We also need to see some easing in the consumer space, and we do expect to see some of that also tomorrow coming out. We have retail sales. There, we are expecting a headline to remain rather robust, but really driven by autos rebounding as well as higher gas prices. In the control group, which really feeds right into the GDP estimates, that's going to be more modest at 1/10 month over month. But importantly, it's worth noting that measure is really looking at goods. So we're really not getting a peak yet at services spending, which is really where a lot of the pressure is coming from in terms of prices and the upward pressure on inflation that we are seeing. So, again, what we are seeing so far in terms of the services space, this PPI report showed the highest print since July 2023 for final demand services. And it's just not something that we or the Fed want to see in terms of getting inflation under control here.
Thanks very much, Michael. Now we head to London to hear from Cathal.
Thank you, Simon. For this edition, I'm going to focus a little bit more on the Bank of England from a European perspective. And there's really two reasons for that. One is we had a meeting last Thursday, so it's still fairly fresh. And the second is we had quite a kind of a shift from the Bank of England in terms of its communication at that meeting. Now, our expectation for some time has been that the Bank of England will deliver a first rate cut in August. But the MPC's language was still leaning or had a somewhat hawkish tilt to it, shall we say, certainly up until last week's meeting. So the question for the meeting last week was, how would the MPC adjust its messaging to more explicitly signal that the rate cut we think it wants to deliver was imminent, if you will? Now, there are two ways that was accomplished in the meeting. The first was the vote split, a 7-2 split in favour of a hold, but significantly, one of the deputy governors of the bank, Sir Dave Ramsden, switching his vote from a hold to a cut. But the second was an adjustment to the MPC's language, to a much more data-dependent formulation. So the MPC is now saying that it will consider forthcoming data releases and how these inform the assessment that the risks from inflation persistence are receding. Now, there was a second signal within the minutes as well, which basically pointed out that for those members continuing to vote for a rate hold, there was a varied burden of proof required for them to adjust their vote. So the message was pretty clear. MPC meetings are live from here. We've a little over a 50% chance of a rate hike priced in for June, and we're fully priced for August. Now, as noted by Governor Bailey at the meeting last week, there are 2 rounds of labour market data between last week's meeting and the next one in June. Now, we think the MPC is placing greater weight on the inflation releases rather than those around the labour market. And there's a good reason for that. We have an ongoing problem with response rates to the labour force survey here in the UK, which mean we and the bank and the MPC are treating what they're showing with a degree of caution. Now, we had the first of those releases this morning, showing kind of the broad trends we've seen of late continuing in the UK, a loosening in the labour market, but wage growth still elevated and coming down much more slowly. In terms of inflation, we are moving into a new pricing period for UK regulated domestic utility prices, and that should see headline CPI return to target for a period certainly between April and June. But within that, those CPI releases, those 2 CPI releases I mentioned, services CPI will be key. That is the one that the MPC have repeatedly said that they are focused on. Now, what they're looking for is services inflation, which surprised a little bit to the upside in the last release, coming down from 6% to 5.5%. So a hefty drop, if you will, in the next print due next week. Now, our reading of the MPC is that for some of the 9-member committee at least, or certainly for those who voted for a hold last time, just the data coming out in line with the forecast will be sufficient for them to change their vote. So we don't need to see downward surprises in the data for a number of the MPC members. We just need to see it coming out in line with what the bank has set out in the May forecast round. So for the Bank of England, the starting point for the cutting cycle is now much more data dependent than it was previously. As for what comes afterwards, our view for some time has been that the Bank of England will be cutting into a recovering economy with a still tight labour market. So we think that will limit the amount of easing they ultimately deliver. Now, for the ECB, the case here is somewhat different. It has heavily telegraphed that it is likely to begin its cutting cycle in June. Now, there's been no let up on that rhetoric in recent weeks, and our view is that the remaining data that's released ahead of the meeting next month would have to show a significant surprise for the ECB to delay the start to its cutting cycle. Beyond the June meeting, however, the ECB has provided comparatively little guidance. President Lagarde has just emphasised the flexibility and the need to remain data dependent. Now, our view is that the data is likely to lead the ECB to adopt a fairly cautious approach. Measures of domestic inflation, similar to the UK, have remained sticky, and the annual rate of services inflation has eased just 0.3 percentage points over the last 6 months. Recent activity data has also shown signs of an upward tick, similar to what we saw here in the UK. So for the ECB, we look for a total of just 75 basis points of cuts this year.
Great stuff, Cathal. Now we turn to Su-Lin in Sydney.
Thanks, Simon. Australian rates have settled down over the last week or so after some real weakness and underperformance following the stronger than expected Q1 inflation data and an RBA that discussed a rate hike at its recent May meeting and refused to rule out anything on the rate front. The consensus was the RBA retained a neutral bias, but we're a bit less relaxed about that and would suggest it's only a near neutral bias and probably really a very, very mild tightening bias. Look, the bar to hike is high. The RBA really doesn't want to hike anymore. It's been a pretty reluctant hiker over the last 2 years, but as we've always pointed out, 435 cash is pretty low by dollar block standards and only mildly restrictive. In the context of this edition of Macro Minutes and data determination, the onus is very much on the data to weaken for the RBA to move to a firmly neutral bias and eventually think about some easing. And I think importantly, it's likely to be more than a few months of data or even a couple of quarters. And some of the bumpiness and volatility in the key global data serve as a bit of a warning. So what data do we think is most important for the RBA as it deliberates on policy? I think it goes without saying that the inflation data are critical. Services inflation, domestically generated inflation, are all running around 4 to 5% annually and need to move lower on a sustained basis. Our monthly CPI is still relatively new and it's not the full basket, so the quarterly data is still most important. Then we'd probably say the other key data that we need to watch are the labour market numbers. The important monthly labour force survey has been more volatile than usual in early 2024, and it's hard to gauge the underlying state of the labour market. There's quite a lot of uncertainty, and I think we'll need several months of data for a clearer picture, but we have to acknowledge that the starting point is stronger than we thought. The unemployment rate's basically been sub 4% for almost all of the last 2 years, really tight and below full employment. We need clearer signs of sustained weakening in the labour market for the RBA to be more confident that inflation will move back to target within a reasonable time frame. Without that, key services and non-tradable inflation is likely to remain higher than is consistent with target. We'll get some key clues this week with April labour force on Thursday and Q1 wages on Wednesday, but we do expect both to confirm a tight and healthy labour market consistent with a patient RBA staying on the sidelines. We're recording this edition of Macro Minutes just ahead of the release of the Australian federal budget. And despite a likely second consecutive budget surplus for this fiscal year, which is pretty rare by international standards, we think we will see a return to sustained deficits and a mildly expansionary fiscal setting. That'll be underpinned by across-the-board income tax cuts from the 1st of July and likely further cost of living measures that will boost disposable income and add to demand. It's really not helpful for the Reserve Bank at this juncture. And coupled with a likely doubling in government bond issuance next fiscal year, we expect the budget to be modestly negative for bonds, support tighter swap spreads, and keep some pressure on the curve to steepen.
Very interesting, Su-Lin. Last but not least is Luis on FX.
Simon, the theme of the call, data dependent, is a phrase that I have very strong thoughts about. Jerome Powell said, be clear in your reaction function and the market will do your job. So when the central bank says they will be data dependent, they're injecting volatility into the market, they're taking optionality, which is fine, but there are more elegant ways to do this. You have to understand, I come from an emerging market background where central banks are not stable jobs. It's a colorful art, and they have to play with inflation, politics, now geopolitical events, and hopefully they'll be able to give some support into the growth. So I see a wide array of styles of central banking, and I'd like to illustrate them with some Latin American examples. Chile, by example, is a very orthodox central bank. They have focused inward on their inflation and their inflation targets, and for this reason, they anticipated other central banks and eased over 400 basis points, taking their overnight rate to 6.5%, where they're at now. But they are focused on taking it to 4%, regardless of what happens abroad, which I think is a idea in regards to their currency, which has had negative consequences. It's devaluated. It's much weaker than the other ones in the region, and is being used as a funding currency for others. So, secondly, I would showcase Mexico, which I think is at the other edge of the spectrum. They're also very orthodox, but they're very focused on their currency. As you know, the peso has been very volatile in past times. So Banxico has not been willing to start an easing cycle until they are sure that the market has the same expectations on CPI as themselves, around 4% for the end of 2024. And they also, I think, want to gain some clarity on the FOMC cycle. So they have really lagged their peers, and they kept overnight rate at 11%, just a minor 25 basis points maintenance cut they did. But overall, this has made the peso appreciate significantly, over 17% in the last 12 months. And I think that is the very other extreme of the styles of orthodox central banking. However, I'd like to showcase a third one, which is Brazil. Their governor, Roberto Campos, I think he's a rock star. He's been recognized as one of the best central bankers sometime in the past. And he's taken overnight rates in Brazil from 2% to 13% when we were coming out of COVID. And he has, over the last 12 months, eased rates 325 basis points. And he's been giving the market great clarity of what is the BCV reaction function along this whole path. He has been giving guidance of what's the BCB's main scenarios and what they are expected to do in the next monetary policy meeting if their scenario comes true. And recently, he actually took some optionality from the market. He made his guidance conditional, and he actually executed on this optionality. He changed the guidance because his scenario was no longer valid, and he actually came with a framework in which he had 4 scenarios, and each scenario defined a different action path for the BCB, and these would depend on the level of risks that the market had on the disinflation path for Brazil. I think there's definitely very different styles, but what I would like to conclude is that I feel very strongly that the central banks build their credibility by communicating with the market, and if they're going to be data dependent for a period, they're taking volatility into the market. They're not building their credibility per se. They build their credibility when they reduce the volatility and they at least share what is the data they are dependent on. So those are my thoughts, a little piece of what's happening in LATAM. Thank you.
Great. Thank you, Luis. And thank you, everyone, for listening. We'll be back in 2 weeks' time. Take care.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.